Joining us from Singapore is Rohit Garg, Emerging Asia Fixed Income and Forex Strategic at Bank of America Merrill Lynch. Rohit, good morning. Thanks so much for coming in today to have a chat with us. I'm going to start with what you think markets are pricing in because it does look like while the economist fraternity is still divided, certain market indicators, whether you're looking at the OS spreads or you're looking at the bond markets, seem to be suggesting that a rate hike is here.
Yes, that's right. If you actually look at what the front-end OIS curve is pricing in, what we can actually derive out of that is that the market's expecting about 40-45% chance that RBI does deliver a 25 bips hike over here.
In your analysis, Rohit, is that justified purely on the basis of India's domestic macros, or is there also a large global element to it?
The market expectations of a rate hike are completely justified. If you actually look at how the inflation dynamics have been panning out, it's important to realize that RBI is an inflation targeting bank. And in that sense, if you look at how headline inflation has been panning out and what even the forward-looking indicators suggest, it does look like we could very well be seeing headline inflation going to 5.5%. And that's not just due to oil prices, but if you look at core inflation as well, core inflation has been hardening as well. We actually see core inflation going to 5.8% more recently. And then on the top of that, the fiscal slippage will also have an upward impact on inflation. So overall, I would actually say that the reasons are quite strong for RBI to actually hike over here. The question really is that whether RBI can provide some more breathing room before they eventually hike rates. Because bear in mind, historically it has been the case that RBI has wanted to actually see how the monsoons actually pan out. And then, of course, we've actually seen oil pull back quite a bit from $80 per barrel to $75 per barrel. And over here, of course, the comments from US as well as Russia suggest that the upside to oil in the near term could be fairly limited. So in that sense, there are reasons to also believe as to why RBI could also adopt a wait and watch approach and give some more breathing room. So in that sense, that's why the market's pricing in more of a 50-50 chance over here.
Rohit, should they actually not do a rate hike right now, change their stance perhaps? Do you think the market will still be sort of left in another 2 or 3 months of uncertainty? Would it not be better even from a communication standpoint, because you know that the market has seen elevated rates, market has seen a lot of uncertainty, for the MPC to come in and say, okay, look, we're starting a rate hiking cycle, and then give some sort of indication that this may not be a very long, protracted rate hiking cycle?
I agree. It's very, very important for the central bank to actually maintain a very clean and clear communication. In fact, RBI's communication has probably been one of the more challenging aspects. If you look at, for example, the last policy statement that came out, that was very much a balanced statement. But then, if you actually read the minutes, that came out as pretty hawkish. So the dichotomy between the minutes as well as the policy statement, it does leave a pretty bad taste in the market's mind over here. And I do think it's very important for the RBI to come out with a very clear message. And what's also important is to stay ahead of the curve. And that's what, if you actually see, Bank Indonesia did. Bank Indonesia came out, it hiked a couple of times in May, and what it said is that it's hiking preemptively and it's trying to be ahead of the curve. So I think that's pretty important, to actually stay ahead of the curve and not stay behind the curve over here.
Important point, Rohit, which brings me to my next question. Big debate domestically as to how much of a factor the currency is going to play in the rate hiking decision, whether the rate defense works for the currency, particularly in India where the bond markets are not entirely open. Your thoughts on that?
In India's case, and as well as I have to say in the rest of Southeast Asia as well, I don't think currency per se has been one of the biggest factors in terms of the pass-through to inflation. The currency as a general stabilizing mechanism for the financial markets, yes, that could be an important aspect. But simply coming from a pass-through mechanism, I don't think currencies these days play that much of a bigger role. That's one. And in any case, and this is what we said previously, that if the deterioration in the balance of payments is coming from the current account side, central banks rarely want to prevent, in terms of central banks rarely want to actually step in the way of it. They actually allow the currencies to adjust to actually take care of that mechanism. But overall, what I would actually say is that it's important to keep the volatility of rupee low over here, and that's what RBI has been able to do that quite successfully in the past. But what's important is to not try to aggressively intervene in order to prevent a weakness in the currency.
On the current account front completely, but we're also taking a hit on the capital account now. We've seen significant outflows. I think 29,000 crore year to date on equity and debt. Debt actually has seen slightly steeper outflows. So while you may not be able to turn the direction of the currency, should you raise rates right now, could you, perhaps, prevent steeper outflows or draw in some money when the global markets stabilize?
I agree. So it's important. So it's important to analyze as to why we've actually been seeing these outflows, especially from the debt side. I can tell you that the outflows have been not only due to the current account worsening as well as the oil going higher, but of course the fiscal dynamics and the outlook for the fiscal worsening has also been one important factor. And along with that, again, this is one important thing, that it's important for RBI to maintain the credibility of its inflation targeting framework. If RBI does actually go ahead with its rate hike and it reinforces its inflation targeting framework, I do think that the bond markets will take it positively, and in that sense I do think we can actually see debt flows stabilizing over here, and potentially we can see flows coming back into the longer end of the curve.
Rohit, just one last question, and this is on liquidity. What is your view on the liquidity management in the Indian markets and the extent to which that has impacted rates? Again, open market operations, should they be driven by an elevated 10-year yield or driven by the overnight call money market rate, which has actually been stable?
That's a very good question, I have to say, because whereas previously, RBI has actually maintained that its open market operations will be driven more by liquidity needs. It's a bit unclear right now as to whether that's really the case or not, because RBI announced one OMO and it stopped after that. It announced the OMO even though the liquidity was in surplus. It's not like the liquidity went in deficit. So we are a bit unclear over here. What we do say is that it's important that RBI does actually perform liquidity operations again a bit ahead of the curve over here. If it does OMO purchases when the liquidity goes in deficit, again, that's not really going to serve the purpose all that much. So it's important that RBI does perform OMO operations and also stays ahead of the curve.
All right, Rohit, lovely to speak to you. Thank you so much for joining us on this important day, perhaps at the turn of the monetary policy cycle in India.